Have you ever considered making a loan to your family or friends, maybe helping a grandchild pay for college or your daughter buy a house? Well, it can be a win-win for both of you, but there can also be some pitfalls for sure. So our financial advisor, Elaine Beadle, is here to help us with this. Elaine, how can this be a win for you and a win for them?
Well, sometimes you have younger people in the family, maybe a child or grandchild who has blemishes on their credit report, and so maybe they don't qualify for a traditional loan through a financial institution, or maybe because of the interest rate they can't afford it, or they can't accumulate a down payment. So this can be a real help to them to move forward. From the lender's side, it can also be helpful because if you have money set aside, you'd like to help them, but you need it back, so a loan is better than a gift. And maybe you're only earning 1.5% on your CDs, and so you'd like to maybe do more than that. So it can be a win-win where if the bank is charging 3.5% for a loan, you're only getting 1.5% on your CDs. So if you do something in the middle, maybe 2.5 or 3, you're obviously a benefit to you lending money to them because you're getting more back, and you're still saving money for the borrower.
And helping a family member in need, which is of course important too. So if there's someone who wants to help a family member, what should they do?
Well, the first thing to do is make sure you have the right interest rate. The IRS has set minimum interest rates that you can use in the loan to call it legitimate. If you charge less than that or you try and charge 0%, they're going to assume that that interest is still taxable to you. So even though you don't receive interest from the person you lent money to, you still have to pay tax on it. So the interest rates that the IRS sets, they change every month. So if you're making the loan in October, the under 3 years, it's 0.38%. If it's a loan that's going to last 3 to 9 years, it's 1.83%, and over 9 years, like a mortgage, would be 2.85%. Now, you can charge more than that, but you have to charge at least that much. And the second thing is documentation. If you don't document it, it's not going to be a legitimate loan. So the individual's name, obviously, their amount, their interest rate, how they're going to pay it back over what period of time. And there's a couple of great websites that can help out here. One's called lendingkarma.com, and what it will do is allow you to put documents together by just filling out some forms. It's a great website to do that. And National Family Mortgage. So if you want to do a mortgage, this website for a fee will actually help you file the right paperwork in addition to do the documentation.
So you mentioned it is quite important to document this also so everyone knows they're on a level playing field, they get it. What is really the crucial point behind that?
Well, if you're the borrower and you're paying interest for this loan, you want to deduct it on your taxes. So if it's a mortgage interest or education loan interest, you want to be able to deduct that. But from the lender's side, there's a couple of things that you want to be careful about. First of all, you want to be fair to those other siblings. So if you die, that loan needs to be accounted for, so that can be part of that sibling's inheritance, so you're fair to the others as well, is one of those things that you need to do. And also you want to look at if that debt doesn't get paid back, then you can take it off as the lender as a bad debt on your taxes as well. So there's important things to look at there.
So bottom line here, you got to be cautious. You got to think about it before you do it. Write everything down if you can. Elaine, thank you so much for coming in. We really, really appreciate your time.
Thank you.